Well, thank you again for the feedback and support of the Wealth Hacker Conference. This is the Truth About Real Estate Investing show, and I am your host, Erwin, in case you didn't know. I still haven't gotten back to all the overwhelmingly positive feedback. The emails are actually quite overwhelming. It'll take me some time to get back to them, but I will get back to each of them. I want to thank you for those who provided constructive criticisms. Our objective from day one was always to provide the attendees value, so expect the next conference to be even better. On a future episode, I'll actually share you some of the truths about conferences. It's not the prettiest story, and that actually may make some of the constructive criticizers rethink their constructive criticism. I'm not being defensive. I just think if people actually had more context, they would actually understand what actually goes on behind the scenes. Welcome. I want to say welcome to all the new listeners to this show. We are currently experiencing a new level of downloads, about 50% above our previous monthly average in 2019. And 2019 is actually about 20% above the previous year. So if you are new to this podcast and are enjoying it, you can sign up for our email newsletter with my show write-ups, show notes, in case you prefer to read versus listen, especially with the links that are included in each episode. They're posted on the website, but of course, it's even easier if you get it right to your inbox. And also, of course, you'll get a notification of new episodes right in your inbox, so you never have to miss an update on an event or an event we're running, or when we offer tickets for the next event at early bird prices, and also great guests. We have another great guest in today's guest, who is a 6-time best-selling author, but we'll get to Derek shortly. If you'd like to help shape the Wealth Hacker Conference 2020, let me know who you'd like to see as our keynote speaker for next year. Simply tag me, Erwin Seto, ERWIN SZETO, on Instagram or Facebook, so I see your feedback. Let me know who you'd like to see. And remember, again, this conference is for the people, and we will reach out to the speakers based on who people want. We've already started reaching out to major influencers in business and investing, including one particular billionaire. Speaking of keynote speakers, Grant Cardone, of course, was our past keynote speaker for the Wealth Hacker Conference that just passed. It just passed on November 9th. Grant's healthy as far as I know. Grant was great to work with and well liked by his team and community. Hence, I made note of how he interacts with people. Grant says people actually don't like him. They like how he makes the money. And if you've spent time around in Grant's workplace, for example, his employees are very successful. And Grant also speaks to, I don't know, but he speaks to how people who invest with him, they are earning healthy returns as well, and that's why they like him. I'm not promoting anything. I'm just trying to restate how he explains why people actually like him. For those who do enjoy money and the options that money provides, you can understand what he means. Personally, from my own experience, when I give money to charities, they're always most appreciative. They don't like me per se. They don't even know who I am. They just like what I'm doing for them. Back to Grant. As big and successful as Grant is, he doesn't act like it. On our scheduled phone calls, Grant would still ask me if I had a couple minutes for him. On November 9th, at the Wealth Hacker Conference, Grant and his family took their private Gulfstream jet plane. I hear that's $60 million to buy, plus the cost of a pilot, plus fuel costs, plus jet parking, if that's what it's called. We sent them a limo, the Cardone family a limo, and when Grant walked into the Toronto Congress Center with his family, his beautiful actress wife, he greeted me like an old friend and asked if I had a couple minutes to discuss his thoughts about his coming keynote talk. My response to Grant was, "Yes, of course, Grant, I have a couple minutes for you." Contrast that to the cold calls, emails, messages from random strangers that you guys probably all get. I get them too. I was getting them specifically for this conference. People trying to pitch themselves as as speakers, or negotiating ticket prices with me. I felt like sending them each a link to the book "How to Win Friends and Influence People" by Dale Carnegie, as basic manners seem to be lost. And then compare that to Grant. Compare that to Grant, who's gracious, acts like he's a guest in my home. Anyways, so one of the rules of the Wealth Hacker journey to success is that the journey is inch by inch, not mile by mile. Hence, I'm always noticing these small things in everyday life that I think that can improve my own life and experience in relationships with, and how I communicate with people. So if a star like Grant can talk to anyone like a guest in their home, then I'm going to do it as well. On to this week's show. We have a very special guest in Derek Foster of Ottawa, Ontario. He's happily married with 8 kids. Derek jokes it's because he doesn't have a regular job, and neither does his wife, so they're home a lot, hence they have 8 kids. Derek is a 6-time best-selling author, and my favorite book of his is Money for Nothing in Your Stocks for Free, because he introduces his strategy for option selling in that book. If you're new to investing in the stock market, I recommend you read Derek's books, as they are written at an introductory level for a grade schooler. I wish I read these books when I was younger, and I'd be so much further ahead. Derek actually on the show touches on why he's not a real estate investor. He has some regrets, obviously. He feels it's a little bit late for himself to get into the market, but he explains why he does this instead of that. He's actually fun. He's actually interesting as a guest in that he's trying to be a nice guest, thinking that my objective is to sell people real estate. I actually had to tell him my objective is to teach people what it is. I don't care what it is. The objective here has always been for the listener's benefit to get them ahead in life. Whatever it is, I don't care what the answer is. It could be like cotton ball farming. I don't know I have no idea if that's a good investment or not. I'm just saying, if that's the best investment that's out there, I want to hear about it and share it with our listeners. Anyways, I'm a big fan of Derek, and it's not easy to get him as a guest, so I bought a bunch of his books to get his attention that I'll be giving away to Iwin members. Derek explains on this show how his strategy worked for him, the mistakes he's made, and his biggest wins. How he lost 75% of his savings before finally getting himself properly educated. So, I've mentioned this many times. Some people seem to get offended by it. So I'm just going to share anyways. The saying how a fool learns from their own mistakes. A smart person learns from someone else's mistakes. Here, Derek is sharing his worst mistakes. So I highly recommend you listen to them, make note of it, understand that, like he said, he was not educated, and then he got himself educated. For anyone who thinks stock options is risky, Derek shares his own experience, strategy in stocks, and exactly what he's trading. Now for the disclaimer, because we do discuss publicly traded instruments on this show. This service is provided to you for informational purposes only and is not investment advice to you or any other person. We are describing the investments we have made for ourselves and is reflective of our own circumstances. Your circumstances are different, and any discussion here is not intended to be and must not be considered to be a recommendation for you to make the same investments. Consult an advisor, a dealer licensed in your jurisdiction, before making any investment decisions. Derek is a nice guy. He's got a family to raise, 8 kids, and I hope I am as well. As an FYI, Cherry and I this week we made a $10,000 donation on behalf of the Wealth Hacker Conference to clothe, feed, and provide presents to Hamilton's most impoverished families. We're still processing payments from the event. It was that busy, and we will make a second $10,000 donation for a total of $20,000. Understand that is about half of our budget for 1 year. And this will cover our entire Christmas budget to support 40 families of the most impoverished families in Hamilton. Our honest to goodness request to the school boards is give us your worst. We don't qualify it. You decide for us who you think are worst off, and we will help them out. So 40 families, and our preferred metric is best Christmases ever. That is what we're looking to deliver this Christmas. I'm honestly not here to brag or show off or anything like that. However, I do believe actions speak louder than words. And we as wealth hackers, we will be the change we want to see in the world. It is my honor to present to you Derek Foster. Oh my God, we have Derek Foster here. I don't know if you know, but like, for example, your books haven't been available for sale like anywhere for the longest time other than your own personal website.
Yeah, I know. Sorry. I know I should be more proactive with that. I used to be really proactive and sell a ton of books and stuff, and then we went traveling and whatnot, and then I haven't really been. I know I should be a little more I don't know. I'm just busy with my kids and stuff. Sorry.
Understand.
Yeah,
Understand. I don't know if you know. There's actually a reseller on Amazon.
I know. I saw that actually. I thought it was kind of funny. I didn't know if to be bothered about it or just kind of like admire the entrepreneurial spirit. So I know it's weird. I know I should really be proactive, get some IT guys in and da-da-da-da-da, but I'm just busy with my kids and whatever. I know it sounds ridiculous to you. I know. I know. I'm probably leaving some money on the table, but whatever.
Yeah, they're $55 on Amazon.
I know. I saw that. I said, well, maybe I should make some available. I'll get around to it. I'm just busy. Sorry. Yeah, I know. I mean, as I say, I was really proactive. Like, I wrote the first book like 15 years ago, and then I was really proactive with it.
Mm-hmm.
And yeah, I'm just sort of, I don't know. I have 8 kids. I'm busy with them, and
it's understandable. I've had lots of friends actually bring it up to me because they know that I've mentioned your book many times.
Okay.
I actually don't know what it was, but I've mentioned your book many times on my podcast now.
Okay.
In case anyone doesn't know, this is Derek Foster, author of Money for Nothing, Stock and Your Stocks for Free, and many other titles. But we've recommended your book probably about at least 7 episodes.
Well, thank you very much.
And that's basically wiped out everything that you did have on Amazon before.
Yeah, pretty much. Yeah. It's wiped out the stock. I mean, we still have stock on the website at stopworking.ca, but other than that, yeah, I know it's pretty well. We actually, when I first started, I mean, it was a while ago, and I just went into Chapters Indigo, and that was sufficient and stuff. But that's kind of run its course and whatnot. So I should be a little more proactive, but I haven't been.
It's actually funny. People have had more success finding your book at the library than for purchase anywhere.
That's interesting. Okay, fair enough. I like libraries, and I remember one time, like, I'm in Ottawa, and I mean, I don't think it was this book. I think it was my first book, Stop Working or whatever. But I remember going to the library one time and just checking if it was available, and there was 87 people waiting or something. I thought, oh, that's kind of cool. I guess people want to read it.
Yeah, it's actually funny because before the reseller came out on the scene, I'm guessing that someone's tracking the stats, seeing how many times people are searching your book,
okay.
and especially on Amazon. I'm guessing that's what happened, and that's why the reseller popped up.
Yeah, you're probably right.
Once lots of people were selling used books, and they all got wiped out until there's only 3 copies left at $150 each.
Okay, there we go. I should start selling books online at $150 a pop, eh?
Well, based on your journey, people complain about me all the time, like, oh, I don't have time to read this book. I'm like, do you understand what Derek has accomplished and what other people who've read your book have accomplished? So, for example, I actually have previous guests on my show who read all of your books in 2007.
Okay. Yes.
Deployed everything he had except for his own home in 2008 and 2009.
Okay.
And then him and his wife were able to retire off dividends in 2011.
Oh, awesome. Okay, so that was a fairly quick plan. I mean, that's not the norm, but that's good to hear.
Not the norm, but then people, and they say, oh, I don't have time to read this book, or I don't want to pay $50 for this book. Like, understand this is what's possible.
And yet at the same time, when you're getting up and going to work every day, I mean, how many hours are you spending, day after day after day?
Mm-hmm.
The time excuse, I get it. I mean, I have a time crunch too. Like, life is busy. I understand that, but it's written at a grade 3 level. I mean, really, it's a 2-hour read at the end of the day, right? It's one movie. It's, a couple of clicks on Netflix, whatever, one evening, and you're done, basically.
Mm-hmm. Now, you mentioned getting up and going to work, but you retired at 34. So I don't know how many hard years you had before you were able to retire.
Yeah. I was a little bit fortunate. I mean, because I was a typical, university student, whatever, did that, graduated when I was 23. Then I worked part-time, I guess. The job market wasn't that good. So headed to Europe for a summer, came back, made a little bit of money, and then went to Australia, New Zealand for a year, and then came back and moved to Vancouver for a year, and then headed out to Asia and taught English and whatnot for a few years. So been sort of traveling around and whatnot. I don't know if it was hard, but it was adventurous anyways, yeah.
But you started investing when you were still in school, were you not? Yeah.
The first investment I made that I recall, anyhow, was investing in a company I worked for called Radio Shack. It's now called The Source. Mm-hmm. Anyways, that was way back when I was 18 or 19, and I bought shares at $60. I bought shares at $24. They had been high as 60. They went down to 24. I thought they were a good deal. I didn't know anything about investing, so I bought them at 24, and then they went down to 12. So I bought more, and then they went down to 6, and I sold them. So that was my first adventure in the stock market. I lost 75% of my life savings at when I was 18 or 19. It was, I don't know, about $5,000 I lost, or
wow.
I don't remember the exact number. That was rather painful, so I swore off investing in stocks. I said never going to do that again. That wasn't very pleasant, but just reading and researching, and I guess over time I gained confidence, gained knowledge and whatever, and said no, this is the path I want to take, and and the subsequent investments did a little bit better than the first one.
So how do people do this? Sorry, I'm apologizing because I just watched I rewatched your George Stroumboulopoulos
Yeah, no worries. No.
It's a good question. How did you do this?
Like I just bought stocks. It's not rocket science. Like I don't know, for whatever reason, people are attracted to the complicated instead of the simple. Somehow people think, hey, if it's really complicated, if it's hard to understand, it must work better. You know what I mean?
Mm-hmm.
And that's not the case. Like the story I always talk about, which isn't actually which is in I think this book actually, is a story of when the Russians and the Americans were competing for space supremacy. And they were who's the first to fly around the Earth in outer space and who's the first to get to the moon and all that. And while they were doing this, they realized that regular pens don't work in outer space because you need gravity for a ballpoint pen to work.
Mm-hmm.
So the U.S. side said, okay, we're going to solve this problem. And they dumped, millions of dollars and thousands of man hours into developing this pen that would work in a zero gravity environment. And they were successful. They accomplished that. And the Russians didn't have the budget, so they just sent their guys up with pencils, like simple works. So I think it's the same with stock investing. I mean, I just find I try to focus on things that, I buy and use on an everyday basis. So, Colgate or Crest toothpaste, I mean, those two have been around basically when I was a kid, when my dad was a kid, even when my grandfather was a kid, So it's not that complicated, and people, hopefully keep brushing their teeth every day,
Mm-hmm.
and the dividends just keep rolling in. I mean, it's really not all that complicated.
Oh, I'm sorry. I'm just tempted to ask about more complicated because, like you said,
Ask anything.
What's the most tech? Do you do any tech stocks at all, like Apple or?
Yeah, so I'm a computer idiot. I really am. I'm not that smart. Okay, so the intelligence that I have, it prevents me from doing that kind of thing. So I just don't play in that sandbox because I have no sort of competitive advantage. So yeah, so I've missed Amazon, I've missed Netflix, I've missed Apple. I mean, Apple's actually kind of interesting because it was a hot stock back in the 80s, and then it crashed and burned, and it did nothing for 15, 20 years. And then the last, 15, 20 years, it's done really well. Mm-hmm. So it's been a hit and miss. I'm just not smart enough for that. I mean, the most techie thing I have, and you're not even going to consider it techie, would be Visa. Okay, because it's a payment processor. And, people think, credit cards are risky, but Visa doesn't operate that way. They don't lend out a penny. What they do is they charge the banks to be able to issue their card. And then they also get a tiny little piece of every transaction that, you swipe and whatnot. So it's pretty idiot proof. I like the model. That would be, even though some people would call it a financial stock, I think it's more of a tech stock, but that's as complicated as I get. Otherwise, I stick to toothpaste. I'd rather invest in something like I own shares in Pepsico, which makes potato chips. So I'd rather invest in potato chips than computer chips, I guess.
That's funny because I trade Coca-Cola right now. Not the same as PepsiCo, but
yes. So right now I'm talking about the companies that I buy and hold. I do trading as well. I have different accounts for different purposes, but you were asking me about dividend investing, so that's what I was talking about there.
Okay. What kind of accounts do you have? How do you divide your investing?
Yeah, so I have my personal account, and then my TFSA, and then of course my wife's personal account, and my wife's TFSA, and then I guess she has a spousal RSP account. So those are my personal ones. And then with my books, I have a corporate structure, and I guess I have a corporate trading account there as well.
Mm-hmm. And then do you have different strategies for them, or is it all the same strategy?
Yeah. So in my personal account, I tend to be a buy and hold investor. So, if you look at my book, Stop Working, or you look at my book, like The Idiot Millionaire, like a lot of the holdings I have would be in the Idiot Millionaire book, because that lists 50 or so what I call idiot-proof stocks that have, a habit of increasing their dividends year over year. And that's the strategy I focused on initially. Like I know a lot of investors are hoping to, and I will get into the options trading in a minute, but they're focusing on buying, ABC company for $10 and selling it for $20 and making a quick gain and get out. I'm not looking for that. I mean, the analogy I gave, I think it's in my first book, is, the typical investor, what they want to do is they have their capital, their investment money, let's call it the seeds. And what they want to do is they want to plant a tree, but as soon as the tree grows a little bit, they want to chop it down, sell it off for firewood or whatever. I don't want to do that. I want to plant seeds and grow a tree, but I want to harvest the fruit, because then the next year I can come back and harvest the fruit again, and the next year again, and the next year again, and the next year again. So, I mean, I'm just pulling this out of my head because I know a little bit about it, but the example I gave a few minutes ago about Colgate toothpaste, again, it's an idiot-proof, simple enough for a 6-year-old to draw with a crayon. Everybody understands brushing their teeth. We're told to do it, from the time we can start talking, basically. But if you actually look at Colgate, I think they've paid uninterrupted dividends since something like 1895. So that's like 125 years consecutively of paying dividends. I mean, that's during the First World War, during the Second World War, during the Great Depression, all the way back beyond the last time the Toronto Maple Leafs won the Stanley Cup. Let's say, they've kind of been paying dividends, and they've increased it for over half a century. So every single year, they increase the amount of money they're paying out to you. So it's really not that hard. You buy the shares and you tuck them away in the drawer, and the check gets mailed to you every 3 months, and you spend it and you live. I mean, you can't get more simple than that, really. So that's how I handle my personal account, and it's balanced roughly 50% US, 50% Canadian, roughly. I don't know the exact percentages right now, but in that neighborhood. In my TFSA, I have mostly Canadian stocks. Because there's a withholding tax, there's a dividend withholding tax on U.S. source dividend income. So I have Canadian stocks in my TFSA, and that's done reasonably well. Similar, my wife's account is managed in a similar fashion. And then within my corporation, there's a thing called a capital dividend account. So essentially, for every $100 you earn, you can take out roughly half of it on a tax-free basis. And so that's where you want to be triggering your capital gains and whatnot. And that's where options are used a little bit more often.
All right, fantastic. I have so many questions to ask, but let's just mention options. Why do so many people think options are risky?
Because they can be risky. I guess they can. I mean, it's kind of like a chainsaw could be risky if you don't know what you're doing, if you're not using it properly. I mean, every day you get in and you drive a car can be very risky. I mean, a car can cause a lot of damage if the operator of the vehicle doesn't do it right. So everything can be risky. It's the key of doing it correctly versus doing it incorrectly. So with options, I think you have to be cognizant. It can be very tempting to sell more options than you have money to cover it. And I think I emphasize very strongly in my book that you should have the cash sitting aside so that you can cover your position, because that's where you get into trouble. Like, you could have hypothetically a couple $100,000 sitting in your account, and you could sell a couple $1 million worth of options. I mean, you have that possibility. Mm-hmm. And then if things go wrong, you're in deep trouble. So I think that's one element of it. The other thing too is people move a little bit further out on the risk curve, I guess, with options. Like, I mean, so the options I'm selling generally are the same kinds of companies that I want to hold anyhow. I mean, my rule to myself is, hey, if I don't want to own the stock, then don't sell put options on it. So just today I closed a position on Colgate toothpaste yet again, you know what I mean? And pocket a little bit of money, and, everything's good. But had that option moved the wrong way and I'm forced to own it, I'd be totally content owning Colgate toothpaste. And, so often with options, you're tempted to take a casino type approach and move over to the higher risk issues because the premiums are so much higher. You pocket a higher rate of return, but you're taking undue risk. So I think that's why options are risky, because some people blow their brains out with them, not literally, but you know what I mean? Just financially speaking, they don't take the necessary precautions, I would think.
Mm-hmm. Options, I think people need to understand, is just a ginormous topic.
Yes.
In interviewing people, I always ask people about their experience with options, because I always look for learning lessons, right?
Yes.
I've heard so many people say they've lost so much money on writing naked puts on weed stocks. So was the option the problem, or was the underlying the problem?
I think the underlying is the problem, because I think had they instead just taken their money and bought weed stocks, depending on when they bought it, if they bought it early enough, they've done okay, but they would have done okay in options as well, quite honestly. But yeah, they've tumbled whatever it is, 60%. I don't follow it because I don't buy it, but 60% this year, whatever the number is. And yeah, that's following the underlying, right?
Right.
I mean, and they were tempted to write that because the premiums were probably pretty high because the volatility was high.
Yeah.
But think about it. I mean, if you look for something that's blue chip first, okay, I tend to like American options more just because the market is deeper and broader. There's more. There tends to be less of a spread. There's more activity and whatnot. So I tend to look for nice, big, old American blue chip companies, basically, right? So, let's say something that's on the weaker, like lower end of the range, like Colgate. Colgate was not trading super cheap, but I don't know what it was trading at, around $66 or something. So I think I sold some options at 64, and it went up, whatever it was, 88 cents today or something. And I looked and I could pocket a couple $100, in a day. So I said, I'm just going to close this position. And, I could leave it open, I suppose. So you can look for companies that are trading cheaply, first of all, and then you sell options, and they have to be stable blue chip companies. And then you sell options at a lower price than they're trading at anyhow. Mm-hmm. And then, and again, you're looking for dividend-based companies too. So I think I sold some options on Exxon that I'm still holding. Mm-hmm. If I'm forced to take those, I think the dividend yield is going to be like 5.2%. And that's a dividend aristocrat. I mean, they've increased their dividends for 25 or more consecutive years. I don't know the exact number, and it's one of the few AAA rated U.S. companies. So it's not going to disappear tomorrow. You know what I mean? And if I am forced to take it, which is always a possibility, I'd be happy to hold it, but I might sell covered calls on it on the other side and make a premium right away. You know what I mean? Mm-hmm. So I don't think it has to be risky.
So I understand this stuff. I do want to take this back to for the beginner. Like, for example,
Sure.
I have friends who are journalists who've never even looked at a stock and don't know what a dividend is, for example.
For sure. Yeah. You guide me through and I'll answer the questions. Absolutely.
Could you take me through your Colgate? Because you mentioned you closed your Colgate. So can you start from the open? Maybe, I think you've explained your decision-making process, dividend aristocrat, meaning, actually, what defines a dividend aristocrat? Top 10 or something?
Okay, let me go through that. So first of all,
please,
if I'm looking at companies, let's go through the criteria of the companies, which I think I talked about in my first book, Stop Working, Here's How You Can. But the criteria of the company is very important. So first of all, I'm looking for something that's simple because I'm not that smart a guy, right? So if it sells a complicated product or is into biotech or nanotech or something like that, it's too complicated for me to understand. I'm not going to touch it. Okay. Now, something like Colgate is very easy to understand because everybody understands it. You simply put a little bit of toothpaste on your toothbrush every morning. You brush your teeth, off you go, whatever. And when the tube runs out, you go and buy another one. That's very, very simple. So first of all, it has to be simple enough for, as I say, a 6-year-old to draw with a crayon. But the second thing is it mostly recession proof? Not 100%, nothing is. But Colgate would fit the bill of that, right? Even if we have a recession or whatnot, you're still going to brush your teeth, right? You're not going to give that up. There's other things you would, but you're not going to give up your toothpaste, presumably. So simple. So it's a company I want to own. A dividend aristocrat, answering your question, is a company in the U.S., is a company that's managed to increase their dividends for 25 consecutive years or more. I don't know the exact number. I think there's somewhere between 50 and 60 companies that have managed to do that. I might be a little off on my numbers. I don't count them necessarily, but that would fit the bill because it's increased its dividend for 50 consecutive years, right? Which is over 25. So it's a company, first of all, that I'm very happy to own. What I mean is if I sold options on it and we had a repeat of 2008, 2009, and the stock cratered and suddenly fell 30% in a couple of months, I would be forced to hold it. And I wouldn't be worried about it because I still think that it's going to exist. It's had crash. The stock price has gone down before. It's gone through recessions, whatever, and it's survived. So in that particular case, I might be forced to hold it. If the option is exercised, I'm forced to hold it. I'm okay with that. Are we? Is that okay so far?
Oh, yeah.
Yeah. And then the dividends are simply just to check that. So Colgate goes and sells some toothpaste, and let's say it makes $100 million or $1 billion, let's say. And let's say it has a billion shares outstanding. So it basically makes $1 for every share. And Colgate's a fairly mature company. They're reinvesting a little bit in their business, but a lot of that is just, cash that they can return to shareholders. So Colgate might, if they make $1 per share, they might pay, 50 or 60 cents a share to shareholders in dividends. In other words, they'll send you a check or it'll be done electronically, whatever, for 50 or 60 cents for every share that you have. You'll get that money, and the remainder of their money they'll reinvest in their business in some capacity. They might build a new plant in India. They might, buy one of the local brands. They might enter a new market. I don't know exactly what they're going to do, but you know what I mean? They retain a portion of their cash too, which promotes growth over time.
So my mind's pretty crazy. It's full of squirrels.
Sorry, I'm trying to explain it as clearly as I can. I'm sorry.
No, your explanation is perfect. It's where my mind is going for the next question.
Okay.
Because I've been accused from my podcast and talks that I give that we only share with the roses. We think as if everything's roses. Actually, you just mentioned the massive correction 2008, and then something more recent. And actually, I'd like to get your opinion on how you would handle such a situation. For example, like Kraft Heinz.
Yes.
We all know ketchup. I think we all have it.
Yes.
So for those who don't know, they had an accounting scandal and the stock price was decimated. Did you happen to have any Kraft Heinz?
Yes, I did have some shares in Kraft Heinz.
Mm-hmm. And then how did you handle that situation? Did you
I still have shares in Kraft Heinz. Yeah. So occasionally investing is never absolute. I mean, we're in good company. Anybody who has bought Kraft Heinz, because Warren Buffett owns whatever it is. I don't know the exact percentage, 27 or 28% of the company or whatever it is. But yeah, so occasionally you are going to have errors. And Kraft Heinz is a good example, actually. I'm glad you brought that up. So what's basically happened, a couple of things. First of all, consumer tastes do change. So they are changing. Younger generations are less interested in the processed foods than previous generations were. So that's one aspect. And the other aspect is I think the store offerings, the PC Financial products or the Costco equivalents or even the Walmart equivalents to a point, their quality has improved, and I think they're stealing some share from Kraft. So Kraft does not have the same pricing power that it did, 10, 15, 20 years ago. So sometimes the landscape does shift. Fortunately, generally with the big blue chip stocks, it takes a long time to shift. It doesn't shift quite as quickly as with high tech stocks or other things like that. But yeah, there are mistakes. So answering the question, sorry. So I own some shares, not a huge amount, but I own some, and I'm still holding them, collecting the dividend. But yes, I've up until this point in time, if I were to sell them today, I would lose money on those shares.
Did you sell any, or you just held all of them?
No, I just held all of them. No, I don't tend to sell after. I mean, it's kind of like closing the barn door after the horse has already run away. I mean, you want to leave the door open so it might come back, sort of thing. So it's the same. It's the same with the stocks. I mean, I don't think Kraft is destined for bankruptcy or whatnot. I understand there's an accounting scandal, whatever, but there is real value there. I mean, Heinz ketchup, go to any fast food restaurant except for McDonald's because they eliminated it because it gets complicated. But Warren Buffett dealt with a company called 3G. 3G helped buy Kraft Heinz, and they also happen to own Burger King. So it's a big competitor of McDonald's. They didn't want to feed their competitors, so they don't. But generally speaking, go to any fast food restaurant, go to any kitchen table, yada, yada, whatever, you will find Heinz ketchup at a lot of places. I mean, people like it. Kraft macaroni and cheese, a lot of the other products, they still exist. They're still selling. It's not going to disappear overnight. So yeah, so I'm holding it. I mean, obviously, I paid too much for the stock. It's gone down since I bought it. That's part of investing. Nothing's perfect, and onward and upward. There we go, sort of thing.
Mm-hmm. Did you acquire more to average in or anything like that?
No, I didn't do that either. I did absolutely nothing. Sat here and sucked my thumb, I guess. Yeah, maybe I will. Again, it wasn't my favorite company. It wasn't a huge holding. It was one of my holdings. I generally prefer companies that are not competing quite as price consciously. So an example I would give hypothetically is Pepsico. Now, people think Pepsico, they think Pepsi-Cola. It's the second strongest, after Coke. I get all that, as far as the drinks business go. But bigger in PepsiCo actually is their chip business, right? That's a huge business. They own Ruffles, they own Lay's, they own Doritos, they own Smart Food, they own, and if you walk down the grocery aisle of any grocery store, and you go to the chip aisle, probably 70 or 80% of the shelf space is dominated by the PepsiCo, Frito-Lay brands. So they're really dominant in that area. But the thing I like about that company a little bit more is they're not only sold in the grocery store. Like, people will pay up for those products. But if you're on a one-off, what I mean is if you're driving and you stop at a convenience store, you get some gas, then you just have a craving for a pop and a bag of chips, you're going to reach for the Pepsi or the Coke, and you're going to reach for the Ruffles chips or Doritos or whatever and you're not going to care that maybe you could get a no-name brand for 60 cents and you're paying 90 cents, or maybe I'm dated on my pricing, but you know what I mean, right? You're not as price sensitive as when you're doing your grocery shopping and you're filling up your whole cart. So I think they have a slightly stronger position, and I would add that for Colgate. I'm not pounding the table for Colgate, by the way. I'm just using an example. Once again, Colgate tube of toothpaste, they have the fancier, the Optic White or whatever. I think it's $4 a tube or whatever it is. Down at the bottom shelf is the simple, basic Colgate. It's like 99 cents. If Walmart came up with their own toothpaste for 69 cents or something, I don't think for 30 cents. I don't think most people would do that, So I think they have a little bit more pricing power, a little bit more brand power. Misread Kraft a bit. It happens. On we go.
Well, I think everyone misread it. Even Warren Buffett, the greatest investor in the world, misread it.
Sure, fair enough. Yes. Yeah, there will be hiccups too. You're not aiming for perfection here. You know what I mean? It's kind of like in hockey. I mean, you take a shot and sometimes it goes in, sometimes it doesn't. But if you can dominate the play and keep it in the other team's end most of the game, you'll probably end up winning. And it's the same with investing. I mean, you follow your criteria, you buy what you think is the best to buy, and most of the time it turns out all right. I mean, my approach tends to be a lower risk strategy because I focus on, the blue chip companies that are already proven. But sometimes it goes wrong, and that's just the reality of investing. Mm-hmm. And that's why, again, with options, it would be risky if you hypothetically said Kraft is a good deal and you sold tons of options above and beyond the cash that you actually had, you'd be in trouble. But if you bought it, if you bought it, the price is down right now, and so you're sitting on a paper loss and you're still collecting the dividend and whatnot, and it's a small portion of your overall portfolio. It's not catastrophic.
How many different stocks do you own?
So I follow a lot, but own in my solid portfolio it's about 30, and then in the options account I probably play with 6 to 8 or something. And sometimes it's the recurring names that are coming back again and again too. And sometimes there can be some overlap with my main buy and hold portfolio. Sometimes not. It would just depend. Does that make sense?
Yeah, for sure.
But usually around 30, 28, 30, somewhere around there.
So we talked about losses. Can we talk about wins? What's been a big win in your career?
Okay, I can go back in time. Let's go back in time. I remember my 20s. I enjoyed that. So when I was 25 or 26, I think I was 26 or maybe 25. Geez, I don't remember. Anyways, around that time, I lived in Vancouver for a year.
Right.
And,
sorry, Derek, can you just share with the listeners how old you are now? So they have
yeah, I'm 49. I'm sorry. 49, half a lifetime ago. Geez, I'm getting old, eh? Thanks for that. But anyhow, when I think I was 25 or whatever, moved to Vancouver for a year. And around that time, and this was in the mid-90s, so we're going way back in time, but the U.S. tobacco companies were being sued by the U.S. government, and the stocks just got hammered. They went down, 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 and ultimately they signed a settlement. I forget what it was for, something like $25 billion a year, whatever it was, right? Which sounds enormous. But when you actually did the calculations, I'm going back 25 years here, but it's something to the effect of for every nickel that they raised the price of a pack of cigarettes, the company's revenues went up $1 billion or something. So to cover $25 billion was not catastrophic, but it was just dirt cheap. And again, I'm going back to the mid-90s. Around that time, I stumbled upon this book that talked about the history of the tobacco industry in the United States, which I guess I'm a boring guy, but it was kind of interesting to me. And I was reading through, and the legacy brands in the States, the market leaders in the 1950s and stuff, was a company called R.J. Reynolds, and they owned Camel and they owned Winston, Winston cigarettes and a couple of others, right? But the big ones were Camel and Winston. And then Marlboro came out in the late 60s with their Marlboro Man campaign. And they went from kind of being a bit player in the industry, and they continued to gain market share year after year after year after year, eventually overtaking R.J. Reynolds. And I'm boring your listeners here, but bear with me for another couple of minutes. So they had gained market share. So what did that tell you? Well, generally people start smoking cigarettes in their younger years, and they generally tended to remain loyal to their brand. Like nobody walks into a store and says, just give me a pack of cigarettes. I don't care which brand I get. They generally ask for their specific brand. So the fact that this brand had gained and gained and gained and gained market share year after year for a couple of decades or whatever, 3 decades, I guess, by the time I looked at it, or 2.5, it meant that the demographic profile of their customers was much younger than the R.J. Reynolds customers, because that was more of a legacy brand. So that was all good. And then the other thing too was the Surgeon General's warning in the United States, printed on the pack saying smoking is bad for you, came out in 1964. So from a legal liability standpoint, their liability was less, because once it says, hey, cigarettes are bad for you, it's kind of hard for you to sue them saying it hurt your health, because it says right on the pack, So it gave them legal cover. So anyways, this was a chance in a lifetime. So I did something that I'm telling your listeners not to do, but I was 25 at the time. And so I basically backed up the truck and put my entire portfolio into Philip Morris. And then to add to that, I also leveraged. Leverage is basically you can borrow money from your broker, which is something you should never, ever, ever do. But this is a happy story. So leveraged as well. And I don't know, 6 months later, whatever it was, the stock price went up, 30-some% or whatever. And the interesting thing is the dividends were so high because the stock price was so beaten up that the dividends were able to pay the interest on my leveraged loan. So I wasn't, going deeper in debt kind of thing. And I was able to sell them for like a 30% gain or something. But because I had leveraged, my total portfolio value kind of doubled, or a little bit more than doubled in a 6-month period. So that would be a big win, but it wouldn't be something that I would recommend anybody do. And if you're tempted to use leverage and borrow to invest in stuff, I would encourage anybody to Google the name Willie Durant, or William Durant, or Billy Durant, I guess they called him. But he was the guy that put General Motors together back in the 1920s. Like he put, Buick and Chevy and stuff. And you got to realize General Motors was a behemoth back. I mean, it still is, but it was a behemoth back in the 1920s. I mean, we're going back in time. It's kind of interesting. And so when the stock market crashed in 1929, he went up and he started buying stocks and whatever. And he just kept buying. And I think he borrowed to buy and whatnot. And he ended up basically going bankrupt. I mean, this was a rich guy. And he spent the last, number of years of his life, working at a bowling alley kind of thing or something. So you got to be very nervous about borrowing to invest. So this was the winning story, big win, but something that you probably shouldn't do. And I'll give you another big win just for interest's sake is about, I'm going to say 2010, 2011. I don't remember the exact date. Right after the financial crisis, the banks, Visa Corporation was started by a bunch of banks, like a consortium of banks owned it. And then suddenly they needed to raise capital. So they did an IPO with Visa. I wasn't smart enough to buy it at the IPO, but I bought it shortly thereafter. And so I've been holding it since 2010, 2011. So here we are about 8 or 9 years later. I don't know exactly. And it's up about 800%. That's as good as I'm going to get because I don't I don't speculate in unknown tech stocks and stuff. You could do a lot better buying tech stocks, but I just don't do that. To me, it's too risky.
Sorry, Derek, did you say 800%?
Yeah, it's around 800%, 700%, somewhere in that neighborhood. You can Google it and check. But it's been a very, very good stock to buy. I mean, they were making money hand over fist. They had no debt for the longest time, and they just bought Visa Europe maybe 3-4 years ago, I don't know, and consolidated that business. And they just keep growing their earnings quite strongly. I mean, I wouldn't say it's a good stock to buy now, but it's been a very good one over the last, rough almost a decade or something.
Are you able to share what your dividend yield would be on Visa then?
I mean, originally when I don't know, I would be speculating, but I mean, when I first bought it, the dividend yield was like whatever it was, 0.5% or something like that. And so if you're looking at yield on cost, it's probably up around 5% now, 4%. I don't really know. I wasn't really buying that for the dividend. When I first retired, I was chasing dividend income because I need the income to live on. My portfolio income's grown a little bit, so it's actually more tax efficient, and I'm totally happy if a company's paying a lower yield and using that money to grow the business. I'm perfectly fine with that as long as I'm comfortable that the management's not going to do something stupid with the money. So I didn't buy Visa for the yield, but yield on cost or whatever would be around 4 to 5%. But I haven't done the math, so I don't want to give you a firm answer on that. But it's in that neighborhood.
Very cool. Now, Derek, I don't know if many people ask you this. Since we have an hour, we have a little bit more leeway for self-interest questions. So you've been retired for 15 years.
Yeah.
What's it been like? Because most people listening to this show are not retired. They're probably closer to your early years versus very far from retirement is my point.
my lifestyle is not that different than everybody else. The only difference is I don't have to spend the 8 hours a day working and then I guess the hour commuting each way or whatever it takes. You know what I mean? That's about the only difference. I mean, other than that, we live a pretty simple life. I mean, I don't know. In the summertime, I spend time with my kids. We have a pool, so we swim in the pool and play around or whatever. And in the wintertime, the kids are at school, so we do whatever we're doing during the day. And then, I don't know, in the evenings, we help with homework or whatever and bring them to their activities. It's not really that different than anybody else. But I don't know. I found, like when I was working, I found it kind of interfered with my free time a little bit or something. And so by not working, I guess I have a bit more free time. So I don't do it as much as I should, but I try to work out, and I don't really have the excuse like I don't have the time and that kind of thing. And I don't know, I guess because my wife was home too, we ended up with 8 kids, but other than that, not too much different than the average person. I don't know.
Do you ever stress about money? Do you and your wife ever argue about money?
No, never. I don't think that would be an issue. No. I mean, I remember, not almost not at all. I mean, I think we're wired similarly in that regard. So no, I mean, I remember, I don't know, we had a big SUV. I mean, because I don't go to work, we just had one vehicle for a while. And then one of my sons was getting his license. So I thought we'd get a second vehicle. So I went out and looked around and whatever. And we ended up, my wife said, I don't think we need a second vehicle. I said, I don't know. I kind of think we do. And it wasn't a big decision one way or the other. So we got a Buick and everybody's happy and we're all good, but it wasn't, I think we're wired in a similar fashion. So I don't think that could have ever caused a problem.
Right. You ever lose sleep at night over money? Do you have any concerns about money? Like, as in, like, not having enough?
Not really. I mean, no. I mean, no, because I mean, when you plan it the way they say, like, hey, a 4% withdrawal rate or something, and then the market's going down, I guess that would add stress. But if you're just cashing the dividend checks and not touching your capital, I think that alleviates a lot of stress because, let's say the market crashed 50% tomorrow. I'm using a hypothetical example. It's not going to affect the number of tubes of toothpaste Colgate sells. They'll still be able to make their dividend payments. And same with most of my other holdings, Pepsi or TransCanada Pipeline or whatever. I mean, occasionally one of them can cut their dividend perhaps, but on average, it generally works out. I mean, I think last year, if I recall, I think I had like 28 or 29 holdings, and I think every single one of them except for one increased their dividend. So, and the other one just holds steady, So, and it should be like that because that's one of the criteria I look at in selecting the stocks. You know what I mean? But no, don't really lose sleep over it. No, I don't know. No, not at all, really. I mean, no. I mean, I do spend probably more time looking at investments than I need to. I mean, I could probably just leave it on autopilot. That would be good. But I'm kind of a nerdy geek guy, and I kind of find it interesting. So I do poke around probably more than I have to. I don't do much with my portfolio, but just reading and research and stuff. But I don't think that's necessary. But I do.
What are you reading and researching?
Oh, just different stocks and whatnot. Like I'm pretty boring. I mean, I tend to go through the same routine. Like I'm still kind of a dinosaur, so I read the National Post, I read the Globe and Mail real quickly, generally just online. And just if something catches my interest, I might research it more. You know what I mean? Like, oh, maybe this stock would be interesting or whatever. But yeah, nothing rocket science-y, but just like, oh, I haven't thought. I mean, I don't know, a month or two ago, like I noticed Leon's, which is a furniture company, which is generally a pretty crappy business. Their stock was down, and I don't know, I don't remember how I stumbled upon it, but I'm like, oh, that's kind of interesting. And then I looked at it. I think it was around $15 a share, and it was cheaper than it had been. But it's a crap business because it's not recession proof and it's furniture. But at the same time, what I liked is Leon's is controlled by the family mostly. Like most of the shares are owned by the family, and they own a lot of real estate, and that's not really reflected in the stock. So it's kind of like a hidden asset. So that kind of creates a floor for the stock, if you follow what I mean. I found with investing, oftentimes the first step sort of thing is to make sure you're not losing money on the investment. And so with Leon's, because they owned all this real estate they bought 20, 30, 40 years ago, whatever, there was embedded value there. And then the second thing, it's just, I know I geek out on this kind of thing, but it's kind of interesting. And, it's still a fragmented industry. Like there's still a lot of one-off or two-off, family-run furniture stores. And so Leon's is slowly gobbling up a market share. And then I think I came across this report from 2012, which listed the biggest 4 furniture retailers in Canada. And one was IKEA, which we're all familiar with. And then one was Leon's, one was The Brick, and one was Sears Home Furnishings. Well, IKEA is still doing what it always did, and Leon's is still doing what it always did. But the interesting thing is since 2012, Leon's has purchased The Brick. So those two are now one company, even though they're operated as separate entities. So Leon's and The Brick are now one. So obviously that's bigger. And then Sears went bankrupt 1 or 2 years ago, and Leon's picked up some of their leases. So out of the top 4, furniture retailers, 2 of them merged under the Leon's banner, and then Leon's also picked off some of the Sears Home Furnishing stuff. So that's kind of good. Like I consider that a good thing. You know what I mean? It's not going to make you rich. It's not going to make you tons of money over a short period of time. But there's stability there because they own the real estate, and they've been paying off the debt that they incurred by acquiring The Brick. And I mean, I just like the company. So that would be an example. Just poking around and then stumbled upon that, and then so I bought a few shares, kind of thing.
Interesting.
I know it's boring. Furniture is boring, but sometimes the boring stuff does well,
Oh, I sold puts on Bank of America and Coca-Cola.
Okay.
I invest in real estate. We talked a lot about real estate when we weren't recording on another call.
Yes.
But I like real estate because it's really boring. It's mindless.
Yeah. And for real estate, and I'm sure you've done really well, and I'm sure a lot of listeners have done really well. That's not, and I'm sorry, but that's just not for me because I have an experience with my dad where he leveraged, bought real estate, didn't work out, So I buy them through REITs, but I'm sure if you own them individually, that's probably a blind spot that I'm suffering from. But I don't know. I've done okay. I'm not going to get into real estate, but I agree with you wholeheartedly. At least there's a physical building, it has an embedded value there. They can't disappear overnight, kind of thing. So I agree with that. Yeah.
And the other thing I like about real estate is my customer does not care about anything. Does not care about me. They don't.
Yes.
If I move on, as in like I pass, they don't care.
Yes. Yes. Absolutely. They just keep paying the rent or whatever. Absolutely. Yeah. I agree with that. Yeah.
Like it's a business that doesn't like. I'll ask you later. But for example, like a company like Tesla.
Yes.
Is synonymous with Elon Musk. Like, what happens if something happens to Elon?
Yeah, I don't know. Yeah, I've never touched Tesla, and I mean, maybe it's the wave of the future, whatever. But to me, that's the new. I don't know. If you read a book, The Future for Investors, I forget who wrote it. What's his name? Jeremy Siegel or whatever. And the subtitle, I think, was How the Tried and True Triumphs Over the Bold and New. And I don't know, that title has just always stuck with me in my mind because the boring old, Colgate toothpaste that's been around for a century or more keeps churning out profits, whereas the new stuff oftentimes fizzles. I mean, again, I'm dating myself, but there was a time when Nortel was a hot stock. And people used to have Blackberries and they don't anymore. And I'm sure I could, if I sat and thought about it for a while, I'm sure we could list a bunch of things that were the hot thing that ended up fizzling. So
right.
Those kind of things.
Because I'm a simple guy, I don't have a whole lot of mind space to dedicate to the stock world. So at least for my U.S. stocks, I don't touch anything unless Warren Buffett holds it.
Okay, that's fair. Yeah, focus on things again that a 6-year-old would understand, and you won't get into too much trouble, you know?
Mm-hmm. And I actually use that as a back test whenever someone tells me, "Oh, this happened to this stock." Like you mentioned Nortel, so I went Googling. Did Warren Buffett ever own any Nortel? As far as I could find, no, he never did.
That wouldn't be his kind of investment because it's technology based. Yeah.
And then someone followed up with an Apple example. I think it was from 2012, though. But he didn't. Okay. My understanding is he didn't own Apple back in 2012. So again,
so
my back testing works.
He has so much money flowing in that he has to spread his wings a little bit more. So I own shares in Berkshire Hathaway. So I guess I own Apple through Berkshire Hathaway, but I don't own Apple directly. Whether I should or shouldn't, who knows? But I'm just not sure. You know, it's the cool gadget today. Will it be 5 years from now? I don't know. I mean, obviously Buffett's put his vote of confidence, so I guess I own it through him. But I just don't know, you know?
Oh, and you meant old and tried and true. You know, I invest in real estate, but I'm really investing in the land.
Yeah. Ultimately, that's true too, right? Because it gets more valuable over time, right?
Yeah, because that's what's in short supply. Because we talked about this, like immigration, just off the hook. You know,
absolutely. And it was interesting because I own some shares in RioCan. I know everybody hates commercial real estate right now, yada yada. But it's kind of interesting. In the annual reports, they said we focus on the 6 big cities, right? So it would be Vancouver, Calgary, Edmonton, Toronto, Montreal, and Ottawa, I guess, right? So those are the 6. And Hamilton would be in the GTA, somewhat, kind of, sort of. You know what I'm saying? But the big cities, right? And so they're moving out of the towns. But the interesting thing is that's where all the population growth in Canada is. I forget what the growth rate is, but if those 6 cities were like a country, the growth rate would be incredibly high for a developed country. You know what I mean? Like it would be one of the highest in the world as far as a developed country goes, because immigrants predominantly go to big cities that already have immigrants. You know, they tend not to move out into the country. I'm not saying nobody does, but very few do.
Oh, with traffic and the rising cost of gas, like, it makes sense to be close.
Right? Absolutely.
I had another question, because you mentioned going back to your own holdings and what you trade. You mentioned you hold somewhere around 20 to 30 stocks, but you only trade 6 to 8 stocks. What's your criteria to decide whether or not you're going to trade a stock versus buy and hold it? I know you mentioned there's overlap, but obviously you have a smaller subsection for what you trade.
My buy and hold portfolio is incredibly boring because a lot of the holdings I've held for a number of years, and I do sell sometimes, but I tend not to sell if the dividends keep going up, the earnings keep going up, if the company keeps doing well. You know, unless I've made a mistake in my original assessment, I tend not to sell, and even then, I'm slow at selling. So that's very boring. It's like watching paint dry, right? As far as the trading portion, the reason I trade 6 to 8 stocks is because that portion of my portfolio is much smaller, and because I'm dealing with options and stuff in that portfolio, it makes sense to have a somewhat meaningful position as opposed to trading smaller volumes, if that makes sense. So that would be the answer to that question.
Okay.
You know, and I do buy and hold a few in that account too, but generally it's a hybrid approach. I trade some options, and I also buy some stocks, but I'm more quick to sell on that because I don't mind trigger capital gains there. In my personal account, I'm very, very, very slow to sell.
And then, like, for your book Money for Nothing, please just try to explain. I'm not trying to put words in your mouth. Your intention with writing naked puts was that mainly just to lower your average cost base? Yeah.
So I guess I evolved. I guess when I started out, like, Buffett was a big influence in buying and holding stocks that have some sort of quote unquote moat or some sort of competitive advantage that raise their dividend year after year made sense to me. So selling naked puts was a way to get stocks more cheaply, and it was kind of a partial answer to my impatient personality, because oftentimes when I had money, I felt it was burning a hole in my pocket. I'd be looking for an investment, and sometimes I'd choose something that maybe wasn't the best in some cases. So by selling a put option, I can offer to get it even more cheaply, kind of thing. And then if I get it, great, kudos. I get a higher dividend yield to start and a lower price, and off we go. So that was originally the reason that I was selling naked put options, and then that evolved with my corporate account. And then I hate the term because it's almost not in my DNA, but I do trade options as well in that specific account, not my personal one, but in that specific account, because it can be very rewarding. Like, and I don't want to liken it to a casino, but sometimes you can sell a put option, and 2 days later you've made $1,200 or something. You're like, okay, yeah, I think I'll close this position. That That was good. You know what I mean? And I was talking to a buddy that runs his own business, and we were talking about businesses and stuff because I did the books for a while, and we were talking, a few years ago. And he says, the best business is something where you do nothing, you make nothing, you buy nothing, you sell nothing, and options as close to that as you can get. Sorry, I know it's a lazy man's way of earning a buck, but yeah,
So I had family over for Thanksgiving, and I gave my cousin a copy of your book. Is that I finally was able to explain it to him. For example, he's an investor like you. He's trying to get dividends. Specifically, this was Royal Bank of Canada, and he had a limit order out for 500 shares of Royal Bank of Canada. So then I opened up my Interactive Broker app for him and showed him. So you wanted it for what? So whatever price you wanted it. So I showed him what he would have gotten if he'd written a naked put like 30 days out.
Sure.
And then he did the math, and like I left $700 on the table.
Yeah. No, it lowers your initial buy price, which is obviously better, buy low, part of investing kind of thing. Mm-hmm. And it increases the dividend yield as well for dividend investors because you're getting at a lower price.
Oh, but he was kicking himself. No one likes leaving money on the table.
Yeah, I guess not, eh?
So can you walk us through, how do you describe your strategy with your stock option trading?
Okay, so again, it's like Dr. Jekyll and Mr. Hyde. So I have my personal portfolio, which is all dividend-based investing. I just want to reiterate that because
fair.
That's 90% of what I do. Okay, mm-hmm. That's been what I've been doing for I don't know, almost 3 decades now. You know what I mean, and that's what I'm comfortable with. And then over in the Mr. Hyde portion, whatever, when I trade options, so again, walking it through. I can't state this too strongly, but I'm only looking for companies that I would want to buy anyhow. I'm only looking for companies that I would be content to hold in my buy and hold portfolio anyhow. Because if the options, if the price goes against the option and I'm forced to hold it, mm-hmm. I want to be comfortable holding it. Because you can be tempted to go sell options on some gold miner or something else. And you could get into deep trouble. So that's first, okay? So the first thing is it a quality company? And fortunately, when I'm researching dividend-based stocks, I mean, I can use that information as far as candidates that I would consider for option companies because obviously the research is the same if you follow what I mean. So that's first and foremost, absolute preeminence, importance or whatever is focusing on quality companies. After that, I'm looking for companies that, for whatever reason, have traded a little bit more cheaply than they have in the past. So the markets are kind of on the higher end right now. Oh, yeah. So I'm looking for companies that are trading at the lower end. So an option that I have, and it's a few months out, and it's not a great one because there's too much of a spread, it would be a company like Stericycle, and that was a little bit cheaper a few months ago, and it's gone up and whatever, right? That would be one example. But what else? I'm just trying to think here. Colgate is one that I've done. ExxonMobil, because oil is really beaten up right now. I know everybody thinks we're going to be driving electric cars in 5 years or whatever, but I don't think oil is going to die that quickly. And if you want to get in the oil space, I think it's best to own the most diverse, strongest, best player, and that would be Exxon. So I'm very comfortable with that. So that's trading pretty low. So I sold some options on that. Molson Coors, again, that's in a slightly declining business. I'm not in love with the business, but it's still pretty solid and whatnot, and it's trading fairly cheaply, so I have a few options on that. I sold options last month on Nutrien on the Canadian side, and they expired just, whatever it was, Friday, they expired, so I just pocketed the difference. I'm content with Nutrien because it's like the biggest potash producer in the world, but they also own a retail, like agricultural retail chain of stores kind of thing. So I'm very comfortable with that. I was doing it a little bit with Altria for a short time, but that kind of the price has gone up a little bit. So anyway, sorry, I'm getting on and on, but yeah, so you're looking for quality first, then you're looking for things that are trading kind of on the lower end. So far we're still in the same wheelhouse really as buying the stocks. The only difference now is we're trading an option. And then so if I have ABC company, it fits my criteria of a quality company, and 52-week high is $60, and these are blue chip stocks, so they're not super volatile, but the 52-week low is $46. I might sell an option at 42 or 43. I ideally like the option to be close to or lower than the 52-week low. And that's more psychological than anything, but then I'm feeling like I'm getting a good deal sort of thing. Mm-hmm. And then I do that. And often what happens, for whatever reason, because I'm buying things that are beaten up, oftentimes, I'm not saying always, sometimes it doesn't, but, oftentimes what happens is, the stock price, for whatever reason, makes a recovery over the next few days and starts going up. And sometimes, like, if I pocketed, I'm using random numbers here. If I pocketed, let's say, $1 option premium expiring, December 20th, let's say, so a month out or a little bit more than a month, and the stock price goes up for the next 3 days, and on Friday I log in and I check, and the option's only trading at 48 cents. I might close my position. I might say, I got half the money in a week that I would wait a month for. Let's see if I can redeploy this somewhere else. So I'll close the position. Does that make sense?
No, it totally makes sense.
Now, can I go on about this though a little bit more?
Please.
If that's okay. So ultimately, if I do close the position at that point in time, great. I've pocketed the money. I'm happy. Off we go. I go redeploy the money and do the same thing again. Buy, repeat, rinse, repeat, whatever. Off we go. Right? Fine. But let's say it doesn't. Let's say the stock keeps going down. Right? And let's say a month from now, I sold options. So the price was trading at 46. So I sold options, let's say at 42. And now we're getting to the expiry date. Let's say it's today. I know it wouldn't be, but let's say it's today, and it's trading at $40. Well, then I have a decision to make. I'm like, okay, I'm going to be forced to buy this at 42. Now what can I do? Well, I can just allow that option to take action and end up buying the company at 42. And I might still feel that I got a good deal or not. And again, if this was in my buy and hold portfolio, then what I would do is I would simply tuck the stock away in a drawer and forget about it and start collecting the dividend, be happy I got it at a reasonable price. But in my trading account, what I would do in that particular case is either one of two things: either allow the option to happen and get it at 42 and instantly turn around and sell a covered call it at that same 42 price, because I would get the premium going in, the premium going out, if you follow what I mean. That's one course of action. The other course of action is I can do an option rollout, right? So what I can do in this particular case is I can say, okay, right now it's trading at, let's say, I'm just using random numbers here, $40, right? And I threw an option at 42. Okay, so what I'm going to do is I'm going to see if there's a $40 option somewhere in the future. So the option is expiring today at 42. So if that were the case, and if it's trading at 40, the option price today would be close to $2 because it's closing today, if you follow what I mean. So I might look for a $40 strike price, let's say 2 or 3 months out, that's also trading for $2. And so I'll close my position at the 42, I'll open a position at the 40, and then I'll wait. Do you follow what I'm saying? So what I'm doing is, because I'm getting paid for the extra time I'm investing in the option, I'm able to lower the strike price by a couple of dollars. So then 3 months out, if I'm forced to take it, I'll get it at 40 instead of the 42. Do you follow what I'm saying?
I follow. I'm sure a listener might be lost, or at least a good portion of them.
I'm sorry. I'm trying to keep this simple.
That's okay. They can Google option rollout.
Yeah, option rollout it's called, but you can. I really don't want this to be complicated. I mean, that's.
Oh no, I enjoy this because I get cues from you can only make so many people happy. For my advanced people, they're likely liking this. For anyone who doesn't know what a dividend is, this is probably a struggle.
Yeah, so I apologize for that. And no, but the strength of my book story is that they were simple. Like when I first wrote my book, I showed it to my mom. My mom opened it and says, "What's a dividend?" I'm like, "What are you talking about?" so I simplified it a lot, and that's been the strength of my book. So I'm not trying to be complicated, but this is an issue that is a little more complicated.
Do you mind if I ask, like for Colgate Palmolive, do you mind sharing what you, because I brought it up on my screen, so I'm just curious, like what strike did you choose and what kind of term did you choose?
Oh God, and I'm not in front of my computer, so I don't know, but I want to say
it's trading right now for $67.
Yeah, it's up 88 cents or something, or what is it? What is it up on the day? Do you know?
On the day, it's up 63 cents right now.
Okay, but it was up 88 earlier or something, wasn't it? So I just did this today, so it's in my mind, but I'm going from memory.
Yeah. No, it was much higher. It was up. It was up another 80 cents, so it was up like $1.40 from today's high.
So I didn't get it there. No, okay. So that's what we're doing. Okay, I'm going from memory. I might be inaccurate. I don't want to lie to your listeners, so I'm trying to be as honest as I can, but I don't have the information in front of me. But I think just on Friday, I closed a position in Pfizer because Pfizer was up a bit. So I closed a position in Pfizer, and I don't remember what the strike and all that was, okay? But I know I made a profit. I don't remember how much, okay? Like I'm just going from memory here. And then Colgate was one of the ones that was down on Friday, and so I sold an option. Strike price, I want to say $64. I could be wrong, but I'm pretty sure it was $64. I don't remember what the premium was. I'm sorry. Anyway, so that's what I did on Friday. Hang on, let me think, because I did do it on the screen. I want to say that was the premium like 68 cents or something? I don't recall. At a strike price of 64 on Friday, and then today it was up whatever. when I logged in and checked, it wasn't the $1.40 or whatever it was. It was like up 88 cents or 92 cents or somewhere in that neighborhood. But it was enough that the option was cheaper by, oh gosh, I don't know, 20 cents or 25. I think it was 25 cents or something. I don't know. So I closed my position, and I think it was 1,000 shares or something. I'm going from memory, so I don't mean to lie if I give inaccurate information, but it's the best that I can recollect. So, made $250 or whatever and done. You know what I mean?
This is interesting. No, just because I know that's a great return for one day.
Oh, for sure.
For anyone listening, go back and listen to this a couple of times. Write these numbers down, then figure out the return, and that's a great return for one day.
Yeah, well, it's actually 3, I guess, because it was over the weekend. But yeah.
Okay.
Yeah, and again, I might be slightly inaccurate in the numbers I'm given because I'm not looking at a computer screen right now. I'm just going from my memory. But I just did the trade earlier today, so I don't know exactly, but that would be roughly it.
No, this is fascinating. This is fascinating to me. I've never closed a position that quickly.
But hang on, if you can get, so it sounds silly in a way, but let's say my numbers are somewhat accurate. So let's say the original premium was 65 cents. Let's just say it's going to be within a few cents, right? So let's say the original premium was 65 cents, and I could close it at 40 cents. Let's just say. So I'm gaining 25 cents or 40% of the option value in 3 days versus waiting a month. If I can redeploy that money, why wouldn't I?
Mm-hmm. Oh, I think that's actually perfect because I think a lot of people have missed that with option investing. They actually assume that you hold it till expiry.
I do if I'm trying to buy the stock more. Sorry, if you're talking about me and I'm doing it in my personal account, then yes, I would hold it till expiry because I'm trying to buy the stock more cheaply. But in my trading account, if I could be wrong, but if I perceive an opportunity, I mean, you can't be wrong taking a profit in the trading account if I can redeploy it somewhere else, if you follow what I mean. And that's why the other reason I like the American market is just the number of stocks that I'll be able to sell options on is just so much more than in Canada. And the number of stocks I'd be willing to own is just so much more than in Canada.
Right. Because of who my friends are, I had to ask you.
Yeah.
What is your opinion on Canadian banks?
Yeah. So I'm torn with that because Canadian banks have been money-making machines, and they still are. I mean, every time you get a little statement mailed to you, they'll say, hey, our notice of fee changes or something. And if you actually take the time, nobody looks at these, they just throw it in the garbage. But, if you actually take the time to look, every single one of the fee, quote, quote, changes should really be fee increases because everything, we were charging $30 for an NSF check. Now it's going to be $35. We were charging, $1 if you make a withdrawal. Now we're charging $1.20 or whatever, right? So they are money-making machines, and they're really broad and they're really deep. I mean, they have wealth management, they have stockbroker accounts, they have, they're huge. They're huge. On the flip side, there's 2 potential fly in the ointments. One is if we have a recession and sorry, I hate to say this on your blog, but if there's a problem with real estate prices, okay, that could hurt them somewhat. I mean, I know some mortgages are CMHC insured, but some aren't. So that could hurt them. That's one. And the second thing, more of a longer term threat, is just fintech companies and stuff. I'm not smart enough to know how things can be impacted, but I just know that things can be impacted. I've seen it in too many industries now. This sounds crazy and antiquated to anybody listening that's, under 40, but newspapers used to be money printing machines. And now the government has to subsidize them to keep the lights on. You know what I mean? And that's just, the internet has killed that business. Okay. Even some businesses that seemed unaffected by the internet, such as like Procter & Gamble's Gillette business, right? Razors. I mean, that's simple. You go to Walmart, you buy your razors, off you go. Well, now there's like whatever it is, Harry's Razors or whatever, where you can order it to your door. That's an attack on their business. I mean, it's not going to kill them, but it's going to make them have to be more cognizant of, their price increases and all that kind of stuff. So it's just fuzzy to me. Like, is there a way that fintech can bypass the banks totally and stuff? And so that gives me a little bit of reservation. So I do own some bank stocks, but it's a very small percentage of my portfolio, under 5%. And it's just because I'm not sure about those things. And I could be wrong on that, but it's just, again, with investing, you're looking for what the potential downside is first, and then you're looking for the potential gains. Sorry, does that give you an answer?
Yes, you don't never apologize for giving your honest opinion, because this show is called The Truth About Real Estate Investing.
Okay. We're not talking too much about real estate, but anyhow, okay.
That's okay. The truth about real estate is a lot of us are challenged for yield, which is why stocks has become more of a conversation piece lately.
Yeah. I don't. Yeah, sorry. I went in and looked at real estate, and I think I told you this a couple of years ago. This was in the Ottawa area, and my dad had experience buying like fourplexes and fiveplexes and stuff, and he had problems collecting the rent and stuff, and he didn't know what he was doing. And fair enough, but I just somewhat, that doesn't sound appealing to me. But I went and looked, and I think I looked at condos and stuff, and then once you factor in the property tax and the fees and the yields were terrible. I said, "Oh, forget this. I'll just stay with my stocks." Sorry, and I'm sure you could probably show me things that would do better, and you can explain it and all that kind of stuff. But that was just my quick experience, and I said, "Forget it. I don't need the hassle." Sorry, that was my perspective.
But the funny thing is that my stock account's actually being funded by my real estate.
Yeah, I know. That's hilarious. But anyways,
I'm actually using a home line on one of my investment properties. It's a student rental that I rent to Brock University students. I'm using that home line to fund my account. Okay, hang on, folks. For anyone listening, I'm not giving you advice. This is just what I'm doing.
Yes.
And I actually sold a property. It wasn't performing. I couldn't get enough yield out of it, so I actually sold it. And with all that appreciation, I couldn't refinance it or anything. I couldn't do anything with it. I couldn't get more yield out of it. So I taking all that money. I'm going to trade with it now.
Now, why did somebody else bring their money along and buy it if it's such a low yield? That's what I'm curious about.
Oh, they're going to live in it.
Oh, okay, fair enough. Okay, that's a fair answer. Yeah,
right?
Okay.
It's a great. It's that's the nice.
Yeah, I understand. That answers my question. Sorry, that answers it.
Because people, they still need a place to live, and
that answers. Yeah, no, I was thinking just from an investment standpoint. Sorry.
Oh, and then there's all these people who are just looking for a place to park money. Lots of people are just looking to park money. They're not looking to yield at all. Like you said, condos. Usually rough numbers is usually at least half of pre-construction buyers are investors.
Yes.
And so how does that make sense financially unless they're speculating or they're just parking money?
Yeah. And this is dating ourselves, but in 1989, the Toronto market ran into trouble from that. But so I'm not trying to cast a shadow on the whole real estate thing. I just sorry.
Oh no, that's fair. So I invested through the financial crisis, 2008, 2009.
Perfect time to invest.
Yeah, it was actually perfect. It was a perfect time to buy more because in our prices, we actually only retreated a very small amount.
Okay, good.
Ontario Ministry of Finance actually says to expect another 3.4 million people to the Greater Toronto area, which over the next 27 years.
Yeah, I mean, the demographics are in your favor, so they can iron things out a lot. Yeah, there's more than one road to financial security, and real estate is one, and stocks and options are another, I guess.
Yeah. Oh, I prefer both.
Yeah. No, that makes sense. Absolutely, that makes sense.
So again, I wouldn't be doing justice to my friends unless I asked you about Enbridge. I guess I know. Okay. I know you mentioned Enbridge when you were on George Strombo's show. How's your feeling on Enbridge still?
Yeah, you know what? I don't know. George Strombo's show was a long time ago. I don't own any Enbridge shares. I actually own TransCanada, which is somewhat similar, although no more gas focused instead of oil focused. But yeah, I'd be content owning Enbridge. I mean, the thing is all the pipelines are finding it hard to build new pipelines, but that doesn't make the pipelines that already exist any less valuable. It's kind of like if Toronto suddenly put a moratorium on no more building in Toronto. I know it's ridiculous, but let's say that happened. What would happen to the values that are right there already? You know what I mean? I would be very content owning Enbridge. Like maybe 6 months ago when the price was cheaper, I'd be content to buy it. It's not as cheap now, but I own TransCanada. I'll keep holding it and I'll keep collecting the dividend.
Fantastic. Derek, this has been a massive pleasure. I don't know if you know.
Oh, thank you.
I definitely would love for you to come out for Toronto sometime and give a talk to my group. But this has been a pleasure. Your book has meant so much to me, meant much to so many people. I don't know if you know how much people want your book.
Hey, if people do, can I just give a shout out if it's all right with you? If you're listening,
yes, of course.
If they're looking for the book, if they're looking for the book, they can go to the reseller and it's I don't know whatever it is, $47 or something. Yeah, 50. Okay, fine, whatever. And, if they go to my website, stopworking.ca, they can get it for $19.95, okay, it's $20. And actually they can get the whole investment set because there are other books talking about the dividend investing and talking about, like the Idiot Millionaire List, 50 idiot-proof stocks. So they can buy the whole set of 6 books for $89.95. So they're much better off doing that rather than buying the one for $55. I'm just throwing it out there for your listeners. So, if that's fair.
The funny thing is whenever someone buys the set, I've actually seen your set. A lot of people buy your set and then they tag me on social media.
Oh, really?
Yeah, it's a funny thing. It's a funny phenomenon. I didn't ask for it. It's just I get Instagram posts, Facebook posts. I get direct messages of people who took pictures of your whole set, and plus Lee Lowell's book. They have a picture of all your 6 books plus Lee Lowell's book. Lee Lowell is actually coming on next week onto the show.
Is he?
Yeah. If you have any questions you want me to ask him, let me know.
No, I'm just surprised. You're going around. You're pretty proactive with this, eh?
My thing is, what do I want to hear as a listener? And I am like, my questions are my own questions. Well, I have some questions from my friends like Sean, who is a massive fan of you, by the way.
Thank you.
He's in Australia, but some of us are going to make the trip up to Ottawa to take you out for dinner, take you and the whole family, 8 kids out for dinner.
Oh, wow.
Steaks for everyone if you want.
You don't know what you're getting into. You don't know what you're getting into, especially my second son. He eats like a lot. So, yeah, bring your checkbook, okay? Make sure it's full.
No problem. We'll cash some Apple stock to make this work.
There we go.
Are you newer to real estate investing or unsure where to invest next? Would you like to know what the best areas are to invest near the GTA for the best returns on investment? Then you found the right place, as we're here to help both new investors to seasoned professionals. We have helped hundreds of everyday men and women buy their first investment property to their 10th property. It's easier than you think. Hi, my name is Erwin, and you may know me as the host of this podcast, and I'm also the owner of the iWin Real Estate Team, the 4-time Realtor of the Year to investors, as per the Real Estate Investment Network and the Canadian Real Estate Wealth magazine. They've awarded us twice each. My team of investor coaches are licensed real estate professionals who help everyday, hardworking men and women from the GTA grow their real estate portfolio in the most efficient way possible. You are welcome to use any professional or contractor you want, but you're welcome to our own personal Rolodex of professionals. The same people I use personally to build my wealth and become a successful real estate investor. And no, we don't share this list to non-clients. If you're too busy, we understand. You have better things to do. You have dinner with the family, watch the kids play sports. What we do different is we preview properties on your behalf to pre-screen only the ones that are ideal investment properties. Many of our clients, including ones featured on this podcast, will even make conditional offers on a home inspection so they can both beat the competition and have a chance to view the property before making a final decision during the professional home inspection. After the purchase, we can refer you to our favorite property manager, who is a former police officer with 20 years experience with the local police department. He also happens to be well over 6 feet tall and 220 pounds, with a keen eye for finding you a great worry-free tenant, so tenants never call you, and you can go on enjoying life knowing your investment property is taken care of. As an added bonus of as being our client, he actually only takes referrals from us. And note that this property manager is the most well-reviewed property manager I've ever seen in my city. You have trouble getting financing? You're luck. My personal mortgage broker is the best I've ever seen in my investing career. Again, you're welcome to work with anyone you want. This just happens to be the one that I use personally. You may just be talking to the wrong people about a mortgage, whereas my guy has more relationships with various banks and lenders that others just don't have, and they're often less expensive. For any of the above, if you're interested, go to www.truthaboutrealestateinvesting.ca/contact. Again, that's www.truthaboutrealestateinvesting.ca/contact. Fill out the form, and one of the coaches I've personally trained will get back to you. Now, if you don't have a down payment or you don't earn enough income, well, on the first few properties I bought, I actually bought with my in-laws. I partnered with family. They're now my ex-in-laws. But if you don't have family to partner with, then I would suggest you learn how to hack stocks. Like my past guests of this podcast, Omar Khan and Matthew Todman. That's 2 different episodes if you want to go back and have a listen to them. They both earn mid-level 6-figure incomes with only 30 minutes a day by getting paid to own blue chip stocks at prices they want anyways. It's almost money for nothing, as per Robert Kiyosaki says. He also says that knowing how to sell stock options is a must for any professional investor. Professional investors include those who know stocks and real estate. If this interests you, go to www.wealthhacker.ca/stock. Again, that's www.wealthhacker.ca/stock.